welcome back to MIG. This is really a treat for me to see you guys and gals. For some of you, it's the first time, but welcome to the Michigan Investor Group. We used to do this pretty often back in like 2018 through 21, and then had been on hiatus. But we have a good reason to get together tonight. Tonight we're going to talk again about one of my favorite asset classes, maybe my favorite, actually, and we're going to talk again about mobile home park investing. So hopefully you are well aware of that and looking forward to that. So just a quick agenda. I'm just going to give a brief synopsis of why I love MHP so much, and then talk about how Chris and I met, our guest tonight, and then I'll do a brief introduction. And then Chris has a presentation to talk about his space and his background and experience, and then we'll have a Q&A, and for as long as anybody wants to talk, and please just ask away, and then that'll be it. We should be done by 7:30 at the latest, and we'll go from there. And please feel free to, very casual. So if you want to get up and grab a drink or grab a snack, go for it. And then the bathrooms are just go past the second blue column and to your left. Is the bathroom. All right, so supply and demand, and really that's just, I think that's kind of how everything works, right? Supply and demand, and it's just that simple. Today, when I was setting up this area over here, one of my coworkers, Tony, came by and asked, hey, what are you guys doing in here tonight? And I said, oh, we're having one of those investor meetings, like we used to have, and it's about mobile home parks, and it's all I said. And he said, oh, I remember when I was in high school at Northwest, this is probably 40 years ago, when they built some new parks, along Parnell and along County Farm, and he's like, and it was really bad because all these students came to the school, but there weren't any taxes. Property taxes weren't commensurate with the influx of students. And I was like, wow, you just articulated one of the, you in a backhanded way just articulated one of the tenets of why this asset class is so interesting. And we'll get to that in a second. But I want to ask you just one question. Do you think we're going to need more or less affordable housing into the future?
How about any?
Probably unlimited. We need unlimited, right? And there is none. And then when you ask yourself, well, what's one of the most affordable forms of housing? Mobile home parks, for certain people is what they want, and it's most affordable. And what I told you that mobile home parks have negative supply. So when that was something that I guess our family learned about and studied and realized and got some experience with, this is what happened. Now we are invested in all these red dots around the country, mobile home parks. So when we bought into that demand, supply, that's kind of what we decided to do for the last 8 years. So I don't know, I think that's kind of interesting. So 2018, a fellow investor recommended to check out mobile home park space. And I never thought about it, And then so spent a lot of time studying it and got convinced about the supply and demand imbalance and started trying to find ways to invest in the space. And in 2020, another fellow investor referred me to Chris. And at that time, Chris was still full-time banking and was buying parks, on the side. And then we met in 2021 for breakfast down in Charlotte when my family was going to spring break. Got to have breakfast in person. Still full-time banker. And kind of said, well, Chris, if you decide to go full-time MHP, I think we'll invest with you. And I'm not trying to say that influenced your decision. You were moving full speed ahead.
I made the decision.
But then in 2022, Chris told me that he quit his banking job and full bore ahead. And then so we invested in our first deal with Chris in 2022 in North Carolina, and then our second deal in 2023. And then our third deal just a couple months ago, all in North Carolina, which is, we'll hear a lot about, I think, in our presentation today. And so Chris lives in Charlotte area, got a computer science degree from Rutgers, and an MBA from Vanderbilt. And then he worked in banking for many, many years, investment banking and putting together corporate loan syndications and some of that highfalutin stuff that is sometimes over my head, to be honest. And then he started buying parks while he was in banking. And then he formed Six Rock Properties. And now I'd like to invite Chris up to share the story from his own mouth. So please welcome Chris Ebert.
Okay. Thank you guys for taking the time. Appreciate you guys having me out. I guess I'll start kind of giving an overview like David did about the industry and then kind of give you a little bit of background to Six Rock. So we'll start with disclaimer, it's not an offer to sell securities. Actually, I don't have any deals in market right now, but if you're interested in future deals, David will get your email address and we can get you set up on our investor portal. Let's see, so mobile home parks. What is a mobile home park? I view a mobile home park as a parcel with, call it 10 or more mobile homes. That to me is a neighborhood, and that's essentially what mobile home parks are. It's a neighborhood of mobile homes. Maybe the legal definition's 2 or more. And so within that, there are kind of 2 business models as an owner of a mobile home park. There's the land lease, which is what we follow. And so we own the parcel, the tenants own the homes, and we rent out the lot or the land, so true, a land lease. There are a lot of reasons why I think it's superior to the other model, which is a horizontal apartment model. Mainly it's that it's lower expense and lower turnover costs. But the horizontal apartment model is you own the land and the homes. And essentially it's like it says, it's kind of like an apartment. And so you deal with all the same headaches that you would if you owned an apartment. So not as stable, appealing, it's more labor intensive. And so we stick with the land lease model. In terms of the variation of parks, I think it really comes down to the utility setup. So parks can be serviced by public utilities, like a lot of single family homes, or private utilities, so that's a well, individual septic systems for the homes, or a wastewater treatment plant. And so in that, you as the owner, I look at it as a lot like you're a utility manager. And so if you can find a park that is set up like it's an all tenant-owned home and city utilities that are directly billed by the city, that's the ideal. That to me is the top of the top, because at the end of the day, you're essentially a parking lot. You don't have to worry about utilities. You just rent the land and you just collect the money. So as you kind of journey in the space and look at that kind of, I kind of want to put that out there as kind of the top of the top. So there are only so many of them. We do have some in our portfolio, and I plan on keeping them forever because they are so rare. But that to me is kind of the pinnacle of it. Some of the parks have amenities. I think if you look at it like a star system, which is kind of informal, 1 to 5 star. Anything 3 and below don't really have amenities. Maybe a playground. But then think like a 55 plus retirement community in Florida, they might have pickleball courts, clubhouse, pool, things like that. That's kind of a different beast. That's I don't talk about it in the presentation, but like they're public REITs, Sun, ELS, those are the 2 big ones. They're the ones that, again, they're 500 units. They're just their whole entire mini cities really, predominantly Florida, California. High cost places like that. Why do we like mobile home parks? A lot of reasons. Here's kind of the high level that I think. Solution to affordability crisis. That's kind of a PR headline, but really we're the cheapest non-subsidized housing option. And we'll get into some of the details of these in the next slides. Tax advantageous, I don't know if anybody's familiar with cost segregation analysis and bonus depreciation, but there are a lot of advantages with mobile home parks that I'll discuss in a minute. My favorite one, and it sounded like David's as well, is the limited new and existing supply. They're just not building new mobile home parks, at least that compete with the existing stock. Because they are building some, but they're, just a lot of them are in Texas where there's land, some in Florida, and those are the 5-star ones with the, again, the clubhouses, the pools. It's a whole subdivision, and that's, it's cheap relative to stick-built homes, but compared to the kind of the 3-star parks that I own, it's not in the same class. Recession resilient assets. I thought about taking this out. This is an industry talking point, which is true. I'm not as big a fan because past performance doesn't necessarily indicate future performance. I do want to highlight it because in the tenant-owned home model, like most Americans or many Americans with single-family homes, their highest value asset that they own is their home. It's the same for a mobile home owner. And so they're going to do everything in their power to hold on to that. And so that kind of comes first in terms of rent. And if for some reason that they can't afford the rent, or they fall behind, or they can't pay, they'll end up selling it to somebody that can. So you as the owner do have a continuation of rent because of the demand. The demand's, I would say, insatiable. Even in the smaller markets, when I started, so I started 2014, I don't think there was much in terms of materials online about like, oh, you should target this and that. I just kind of put the word out, and somebody sent me a listing for one of those small business brokers, and it was a 21-pad park in the middle of nowhere, mountains of North Carolina. So it was 21 pads, 19 occupied. We still had demand. I think the town is called Newland, North Carolina. It had 600 some people, but there was still demand. We stayed full, and it was not an issue. So I think that just speaks to the supply demand, which again we'll continue to speak about in this. Operating leverage. So the parks, they operate, again, the tenant-owned home model. They operate with low expense ratios and have a unique ability to increase NOI, which we'll discuss. Okay, so affordability. Simply, we're the cheapest. I tell people we're the Walmart of housing. You can't compete with us on price. And again, supply and demand sound like a broken record, but the lowest price feeds higher demand. And so just by every metric, manufactured housing is the least expensive. Tax benefits. This became a hotter topic again because of the One Big Beautiful Bill Act. So it brought back 100% bonus depreciation. So I don't know how familiar everyone is with some cost segregation analysis. Just kind of quickly walk through it. So when you buy a park, or really any real estate, so you hire a firm to do a cost segregation study. And what they do is they break up all the components of that real estate, that parcel. So landscaping, roads, infrastructure, things like that. And there's a legal useful life table that I guess the IRS has. And so what happens is anything that falls under 20 or less years of useful life can be expensed day one. So just kind of high level, if you have $1 million property, usually 10% of the value is land, that gives you 90% of the purchase price for improvements. It varies depending on the setup, but let's say 50 to 80% of those improvements qualify for bonus depreciation, so they're less than 20%. So a lot of times what happens, it depends on the capital structure and things like that, but for every dollar you invest, you get a K1 back that'll have a loss dollar for dollar. So if you put 100,000, the loss that you get under your K1 is 100,000. And so, again, talk to your CPAs and tax advisors, but it really matters for people who have other K1 income because they can offset that, or those that are real estate professionals because then it can offset any income. So, again, the high level of depreciable assets is what makes them so appealing. Okay, so this is my favorite slide. This is, again, David's favorite as well, I think. It just comes down to supply and demand. So more parks are torn down every year than built. And so the demand's not going anywhere, the supply is going down. And so you just kind of know from Econ 101, the value only increases. So there's a certain part of my portfolio that is closely held, myself, or just myself, family members. We plan on holding these forever. And so, because, I mean, just sit here and think 20, 30, 40 years from now, a mobile home park, I wouldn't be surprised if the asset class is cut in half. I mean, because you look at where a lot of them are. I just know North Carolina and Charlotte, and I follow all the news. I get the Google alerts and things like that. Any city, like true urban, there's still a lot of parks in urban areas. Those are going to be gone. I mean, Raleigh's already had 2 over the past year that have been torn down, and they just built townhomes. Yeah.
When they're torn down, like in Raleigh, it's because somebody has a different use for the property. They might pay 5 times for the land what the park is worth.
Yeah. So I don't cover it here. I feel like that's like a whole nother just opportunity to discuss pricing and rents. See, I mean, at the end of the day, real estate, right? It's the highest and best use. And what's happened, and this was a lot of where people saw the opportunity. So the history of parks is very fragmented, mom and pop. I mean, a lot of times they built the park. I mean, they were a general contractor, or I'm trying to think of other people. They just, I don't know, they were handy and they built the park. They weren't professional operators, anything like that. And they had no debt. They ended up having no debt on it, and so it made a good income. They weren't trying to push rents or anything like that. And so what happens is, right, as things built out around it, their lot rents were, let's just say $300, and all the apartments around them were $1,500. It's like, well, okay, the value of a property is based on its NOI. Well, at $300 lot rents, it's like your NOI is only so high. Well, if we tore it down and built townhomes, we could make a lot more money. And so that feeds into the whole, like, lot rents need to be higher so they don't get redeveloped. Like, I guess the best example I can give, because it didn't really hit me until I owned a park that had high lot rents. So we bought a park in Alexandria, Virginia, which is, depending on traffic, 15 minutes from the center of DC. Everything you could possibly need is within a 5-mile radius. It's next to a Costco, Walmart, just everything. So
Alexandria,
Virginia.
mobile home park.
Yeah, amazing. It's amazing.
When's the nearest one to that?
Right behind us, actually.
Okay.
which I can't imagine how much it's worth because there's like 5 million units. It's crazy. But so I guess I should have started by saying, I don't know the exact number, but let's say the average lot rent in the U.S. is $400 now. The lot rents, come January 1st for Alexandria, are going to be $1,300. And it's like, wow, that's crazy. That's a lot. Well, if they weren't $1,300, it would be much better off as, you know, a multifamily or something like that. So I've gotten offers. I've talked to developers, and I'm like, hey, look, I'm making good money. It's worth $15 million as a park. It's like, all right, well, I don't want to pay $15 million for the land. It's like, okay, well, if I had my lot rents at $500, $400, it would be worth a fraction of what it is now. So,
Is that considered affordable there?
oh yeah, absolutely. Yeah, I mean, when I was, this is before I bought it, I was doing my research. The park behind us, they were doing an Airbnb, $700 just for a room. So it's like, yeah, it's definitely the most affordable. Again, it's such a good location. Talking about parks to keep forever. It's like, luckily there, which I think I'll discuss a little bit tonight, the municipality likes the park. They want to keep the park. That's pretty rare. And so as long as they're on my side, it's going to stay a park, and it'll be the cheapest option. We're not even the most expensive in the market. So there are ones that are higher. It's crazy. So again, if there's any slide, any takeaway from tonight, I think this is it in terms of looking at an asset class to invest in. It doesn't get better than this.
So what is the hurdles to the supply, or is it local governance?
Oh yeah. So I mean, try getting the park built. I mean, who wants to live next to a mobile home park? People come out of the woodworks and they oppose it. David touched on it before. So you got the tax implications, right? So mobile homes are personal property, and so they're not taxed at anywhere near the amount that real property is. So and then you have a lot of families, right? So they go to school, they use the resources. Net, it's probably a negative for the city. And then reputation, things like that. It's just very difficult to get the
Well,
bill.
it's, like in Michigan, I think it's impossible to make it economically pencil.
Yeah.
To buy the land and put in the infrastructure, because you're not gonna be able to recover even if your Liberty Township was okay with it, you can't recover the development.
Well, you're right, unless you do a 5-star pool clubhouse, basically a subdivision. So this, I think this is probably my second favorite slide, because if you tie this into the supply demand, I feel like you get the full picture for.
Can you define NOI?
Oh, yeah, thank you. Yes, so NOI, net operating income, is basically the profit for real estate. So real estate values are based off of NOI. I guess you could replace that with profit. And so I kind of say it here, actually. So the NOI, the profit, is what drives the value of any real estate class. So if you can buy a piece of real estate and increase the NOI, you're increasing the value. And so kind of looking at the ability from left to right, easiest to hardest, the first two are actually a function of what I mentioned before about the fragmented ownership, mom and pop. So again, they were doing well, they're making money, they didn't have any reason to push rents, things like that. And so you have this large disparity between mobile home lot rents and the next available option, which is usually a 2-bedroom apartment. So a lot of times, like when I have a deal, I'll show in the market the difference. So you'll see lot rents at, I'll say $350, and then 2-bedroom apartment rent is $1,400, and that's just way too big a disparity. A lot of times what I've seen, the professional operators, kind of the REITs, they'll, not right away, they'll kind of get to a point where lot rents are 65% of the median 2-bed. And so for a lot of these deals, there's a lot of runway. So, so there's that, and then the expense reduction is another part of kind of the non-professional ownership, where going back to what I said about the utility setup, so with public utilities, for example, there's a setup where there's one bill, the owner of the property gets it, and he or she can sub-meter, or they can just pay the bill and they just eat the cost. A lot of mom and pops did that. And so this gives you the opportunity to sub-meter, capture that expense, reduce the use of water, and increase NOI. The other one, I haven't had much luck with it, but it is possible, the renting storage units, things like that. I think the one to talk about is the filling the vacant lots. That's unique to mobile home parks. Maybe it's similar to self-storage where you can build new units. But a lot of times, so this does tie back to mom and pops. They didn't really focus on infill. It's making sure that the park was filled and all the lots were full. There's cost to it, time, money, all that. So a lot of times we'll buy parks and 10% of the lots will be vacant. Well, there's an opportunity to increase NOI profit by bringing in homes, getting them set up, getting them sold. So kind of take all those things, and again with the supply demand, it's really why I love mobile home parks.
Yeah, on the rent increases, I think in Florida they had a maximum amount that you could raise it each year, kind of like rent controls. Is that common?
Yeah, Florida's, I'm sort of familiar with Florida where they have a prospectus for each park when you buy it, which I think kind of sets the rules. It's not really rent control. The true blue states do, like a lot of California, New York does, Oregon just got it. That's actually, I'll talk about, actually it's the next slide. Good segue, thank you. Kind of the potential downsides like any investment. Regulations, that's probably the most common, I think. And I say that because I think it's a given. Florida, it's not surprising, Illinois, I guess people around here know, very not landlord friendly. And so that's kind of a known, but then now it's starting to spread to states like Pennsylvania have been exploring rent control. And then it's kind of a wild card there. I think it is a downside for sure. It's not one that'll take your investment to zero. I think the way I think about it is that going back to the NOI and the ability to increase, it just kind of limits that. So basically it limits the long-term value. It kind of reduces it slightly. It's not one that'll destroy your investment, but you'd be leaving money on the table if you didn't, versus not having rent control. So I think actually, I thought about this after I put these bullet points in. I think from a regulation perspective, and I've been seeing it more recently, and it's just the deals I've been looking at, I'm not as worried about rent control as I am hostile municipalities. So, with zoning, there's grandfathering. So a lot of these, they pass, actually, a lot of municipalities pass zoning ordinances after parks were built. And so what happens is they're grandfathered in. So they can operate, they can stay as they are, they can continue to use them. But some municipalities are essentially kind of spitting in the face of grandfathering clauses, which I believe is illegal. And so there's some where it's like, oh, okay, if you have a lot go vacant, if you don't fill it within 180 days, you lose it. I've seen that many, many times. And similar things to that. Actually, one of my parks in Alabama, they have a rule where the home you bring in can't be older than 5 years. And so it's just those little like death by 1,000 cuts. I've seen that more, and that kind of hurts more than anything. And it's something you can fight, but obviously at a legal expense. So I'm kind of worried a little more about that. So other downsides, actually the reputation kind of ties into the regulations. It's more setting rents is kind of art, not science, because some of them are so low, you can't just triple them overnight and expect everything to go fine. I mean, there's an example in Iowa. This was during one of the elections in 2020. Elizabeth Warren flew down to get in front of the camera and yell about park owners raising rents too much. So while reputation isn't going to necessarily hurt your investment, it's it's a downside as an owner. Let's see, so natural disasters. This to me, I think this is the worst one, because this is the one that can make it go to zero. Granted, you know, the chances are so low, but still, if I were to buy in like a Key West or Tampa or something like that, or what's a fire-prone area, California, I wouldn't be able to sleep easy at night. Because again, being the tenant-owned model, you don't own the homes, so you can't get insurance on them. You can say, oh, make sure the tenants carry them. Yeah, I mean, in theory, that's good. It'd probably be so expensive for them to get insurance. Probably thousands, I mean, in a very, you know, disaster-prone place, it'd probably be thousands of dollars a year at that point. And then you have to track it. Anyway, and so you do have some, you have loss of insurance, but that only covers so much. So that's the one thing, I mean, again, is if you look at this asset class, just kind of any opportunity, just something to keep in the back of your mind. And then the last one, again, this is more as a limited partner, an unfit operator. I think it falls into two categories: fraud or just overly optimistic on the value add items. Fraud, I think you can check out just by their track record, actually seeing what they've done, getting confirmation. I mean, because there's shady people in every asset class, any investment. So that's the big thing. You avoid that, I think you'll be okay. And then the overly optimistic value add. So I think we talked about all the different things that you can do to increase NOI. If an operator says, all right, here's our business plan. We're going to triple rents, bring in 20 homes, you know, build back utilities, like all these different things. I mean, taking one at a time, yeah, that's fine, but doing everything together, doing it within, I don't know, gosh, even 3 years, it's tough. It's very difficult to budget. I think where I've gone wrong is just not, I guess, budgeted the time budget and then the actual monetary budget. It's just sometimes, you know, like I guess budgeting anything, it can be very difficult. So the more you have, the more variance you can have. And so luckily in my situation, it was just me as the owner, and so I'm the one putting in more money. Yeah, so just something to think about as you look at other deals. Risk profile. So this is kind of how I view expected returns. Kind of on the left, the stable core plus, that's kind of like a REIT. Just high quality, no issues, just kind of good location, high demand, really just kind of boring. And then all the way up to the heavy value add, which David knows well, he's invested in a lot of those deals. There's risk, but man, if you have an operator that can execute, and we're able to do that in certain markets, you can do really well. I mean, I guess it's like any investment where higher the risk, the higher returns. And so if you're experienced enough doing those business plans, it's work out really well. So that's it for the industry.
Where's your focus at on that graph? Is it?
So it depends on the investor. So I guess maybe let me back up just kind of our portfolio and how I kind of view the world. So we have 26 parks, 2,000 pads. The way I started 2014, again, to that small park, and just kind of kept testing things out, buying more parks. And I never really thought that I'd build a company and like, I don't know, earn fees and like do all that kind of stuff. I just want to own real estate and make money from the real estate. And so I think we're not that special, but I think what sets us apart is that, and I've been saying this and I hope I continue to say it, is that I'll only do a deal where I want to own 100% of it. So I'll never do a deal just to do it, or like fees, or why some people do. It's like, oh man, I want this deal. I want to own 100%. Oh crap, I don't have enough money. Let me go to other people. Let me get them involved, and we can all buy this together. So with that said, it depends on the opportunity. So really, it's core value add and heavy value add. Like the core, I'm actually under contract on one now where it's what I was talking about before, the kind of unicorn where it's all tenant-owned homes, direct bill city utilities. The rents are just severely under market, and I plan on just rolling myself and a family member. We're just gonna kind of hold it forever. Nothing really crazy to do there. And then we've done the heavy value add. I think that's kind of where, like the Alexandria Park that I mentioned, that was a heavy value add. We had to replace everything. I mean, we basically rebuilt the park.
Like, what do you mean, you need, like underground utilities?
Oh yeah,
roads
yeah,
and
yeah,
lighting and-
yes, all the above. So the roads, the sewer, the water, the electrical, everything. And it was like a brand new park. And we were able to do a cash out refi on that, and it's still cash flowing, and it's great. And so another heavy value, heavy value add infill. We had one where we brought in, I say we partnered with a couple. Excuse me, they basically wholesale mobile homes for a living. And they were local to the market. We knew them before, we'd worked with them. But they helped us infill 50 lots in 12 months. Wild. I could not believe it. And so I guess that's heavy value add.
Not only they help you find used homes, which are hard to find.
Oh, yeah.
Then they help you move them, which is really hard.
Yeah.
Set them, which is really hard. And then there's demand to sell 50 of them.
Yeah.
That's pretty wild.
Yeah. Well, but see, the demand aspect, this is actually trying to rest you about. So we knew that market, right? And so that's a big part. So real estate is all local, right? If you know your market, you have a lot more confidence in your business plan. So like that's like, I talk to other potential investors or groups about, what we've done in like that deal in particular. I don't think we could replicate that. That was like a one-off. The fact that it was in that market, that made it. Because we're having a problem selling 3 new homes outside of Birmingham. It's so annoying. I mean, it's 40 minutes north of Birmingham, but I thought it would have been a lot stronger. And so, that it just speaks to the market. So anyway, okay. Overview. I feel like I covered a lot of us. We can get you these slides, and I'm going to tell you about the team, our portfolio.
How do you get your leads?
So we've been relying a lot more on broker relationships. So before, this could be a long conversation, but I kind of alluded to it before, where a lot of the rush to mobile home parks, kind of when I started, it was mom and pops, right? They don't know what they have, and it's all off market. You call them and it's like, hey, I'll pay this much. Like, oh wow, that's a lot of money. And really, it should be worth like double, triple that. So you're making money on the buy. What happened over time was that everybody's calling them. Well, yes, because everybody's calling them and putting numbers in their head, and the numbers just keep going up the more people they speak to. And so what happened is, and it's all brokers, right? And so it got to a certain point where it's like, we might as well just wait till a broker actually kind of like gets the fish on the hook, and then if it works for us, it works for us. But we're paying the same price if we call or if a broker calls, because they've already put that number in their head. So that's kind of, you know, I've spent a lot of, you know, goodwill money forming the broker relationships, and I kind of, I get first call on, you know, a few of those broker relationships. I feel like that's key. So, let's see, I kind of did the focus, I kind of talked about it where I don't think we're that unique when it comes to mobile home parks. I think it's more, we focus on the blocking and tackling, and like, it's collections and cleanliness. If you take care of that, everything else falls in place. And so, not everybody focuses on that. I think we just kind of, you know, what we're good at and stick to it. Yep.
So how are the bank's attitudes about lending against mobile home parks?
It's gotten to a point where it's basically a set of banks. They love them.
Yeah.
Like a Wells. Well, let's say like it's funny. Wells Fargo has a very big platform for like institutional quality and Fannie Mae type loans, where you know they basically offload it to Fannie Mae. But if you went to your branch and said, oh, you know, I've got a park down the street I want to buy, that's a no-go. But there are some banks where they just absolutely love them. So it's gotten a lot better. You know.
Can you give me an idea on your management perspective and how you manage these parks? Are
Sure,
there
yeah.
on-site managers, off-site managers?
Yeah. So the way we're set up, each park has an on-site manager, and then it's gotten to a point where it's, I hate to call it regional, but it's kind of regional. They kind of oversee kind of like, let's say 8 to 10 in an area, and then I have a head of on-site management. So she's making sure rents are collected, evictions are filed, and it's all kind of coming down. We're very centralized, because the way I looked at it, you know, a lot of the on-site managers actually live in the park. I feel like it'd be a lot to ask them to like update things in Rent Managers, our property management software, for them to learn that, no accounting, stuff like, it's just like, it's probably easier if like we do all the stuff and then we tell them what needs to be done, like go post the notice, go file eviction. And so that's how we have it. It's very centralized, and it all kind of flows down. And actually, what I've implemented 2 years ago, I mean, these are all just titles, but I call it customer service department. So a lot of our tenant base is Hispanic, and so we hired 2 people out of Costa Rica, bilingual obviously, and they man the phones. So potential tenants, existing tenants, anything that they need that the on-site manager can't handle, they'll take care of it. New leases, I mean, it's been amazing. They've been so good. It's I continue to just pay them more just so they don't leave. It's been awesome. So, yeah.
What's your average NOI on a park?
I guess the way to think about it is, it depends on the utility setup in terms of the margin. So it'll be anywhere from, let's say, 60 to 70% NOI. And then you can just do the math where it's like lot rents between $400 and $500, just multiply that times the number of pads, times 12, and then do that expense ratio. So if there's 100 pads at 400, that's what, 40,000 a month? So is that 480,000? So $480,000 times direct bill city utility park, 70% NOI. So 480,000 times 70% is, you know, what's that, 300 something thousand? So, yeah.
So how do you deal with when you raise the rents and the people can't afford the rent and they leave, how are you dealing with the properties that they're leaving behind?
Well, so with the tenant-owned homes, it goes back to that being the
Back
most
to it.
valuable asset. They're selling it. they're selling it to somebody that can afford it. And then that person can.
Yeah.
How do you deal with, old units on sites that,
Very good question. It's wild the first time you see somebody transform a mobile home. I don't know what they do, and not everybody can do it, but man, I've seen some people take like 1960s home and they make them look brand new. Granted, I don't do it, so like it's not easy. It's like, oh, okay, let's just do that for that one. But it's like people have done it. That is something I probably should look into to see exactly what they do. But you really can, again, at least the exterior you can really transform it. Paint does a lot. We're actually doing that a lot in our recent acquisition. We're painting a lot of the homes, and man, it looks so much better. So
Like as a community service thing.
yeah. Oh yeah.
You pay for the painter.
Yeah,
and
I
have
would
a
say-
Weekend or a week. And
Yeah, I would say I prefer tenant-owned home parks. A lot of the money we set aside for CapEx for tenant-owned home parks is for the tenants' homes. Like there's skirting, paint, power washing, stuff like that. It just makes the park look better. And then in my mind, better looking park, better tenant base, higher rents, and it just kind of all feeds on itself, so, yeah.
How do you manage waste removal?
Ooh, good question. So they're all different setups. Sometimes the city provides it. This is part of our taxes. A lot of times we'll just do bins through waste management, something like that. And a lot of times we'll bill back for it, so they'll be paying for that. We rarely do dumpsters because what happens is if anybody can see the dumpster from the street, you're getting everybody within a however many mile radius dumping their stuff in your dumpster. But I thought we were going with it was the actual like large items. We're actually we just implemented this with our newest acquisition. We did I guess it's fall cleanup. We got dumpsters, put them all around the park. It's like this weekend, bring all your stuff, throw it out because man, people accumulate so much stuff, mattresses, everything you can think of, and so like that to me, that's the battle. And all the other stuff is pretty easy, but it's the large item, the bulk items. So, yeah.
You mean people would leave couches out back behind their house, and
Oh.
mattresses?
So, it's funny. If I come back, I should just go through and give old pictures. When I started, I was really like, in the trenches, and I would go and I would see homes that people left behind. Because sometimes, again, we're a land lease model, but you buy parks. Some come with park-owned homes. You got to turn them over. You'd be shocked at what people so often. You go into a home that somebody left, and it's like they still live there. They just up and just vanished in the middle of the night. It's like, I swear to God, the fridge, it's full, it stinks because the power's off. It's like, everything is there. Everything, it's wild. It's crazy. So, market dependent. This is like, I cut my teeth in like a more rural, North Carolina parks. But man, it was a good learning experience. So.
I have another question. When you're vetting parks, how old do you want the homes in there? Because I've actually been contacted to look at a couple around here that are, the thing's falling over and they're wanting me to fix it or whatever and invest in that park. And I go, nobody's gonna move in next to this.
I know.
You know what I mean? So when you're evaluating something, especially you're not living there, what are the main things you're looking at to say, hey, this one fits in my wheelhouse, I'm gonna go for it?
I'm relying on people who can fix to let us know if it is possible. Because we'll put money into homes to get them ready to sell. But if it's just hopeless, we'll remove it. We'll tear it down, remove it. So.
what if there's still people living there, paying their rent?
Oh, then it goes back to helping, invest in prettying up their home, paint, skirting, things like that. Yeah, tenant-owned eyesore, that's tough. That, you just got, as the owner, you just gotta put money into it. You can't expect that. You can't be like, oh, hey, your house looks like crap, put a couple $1,000s into it.
Yeah.
So, yeah, I guess, maybe one last thing. This isn't just to brag about what we've done. I think this is more a strategy of real estate in general, and also ties to the increasing of NOI. So, in increasing the NOI profit, the value goes up. Well, you don't have to sell it, but what you can do is you can refinance, and you can put more debt on it because it's worth more. And you can put on more debt, so much so that by replacing the old debt, you're taking cash out. So in these few examples, we were able to cash out, some of them 100% of what we had put in. So, like the Harmony Place, that's the Alexandria Park. We put in 2.6 million, we took out 3 million after a couple of years. So we refinanced. We still own it, still cash flows, continue to own it. And it's tax-free too, so. Yeah, I think that's what exits. Yeah, I can get you copies of these slides, but
Is this
happy to
your
answer any
Is
question.
this your only like investment assets you have, or is this just
I'm
what
all
you're
in.
talking about
I'm
today?
all in on mobile home parks.
This is it.
I looked at self-storage in 2021 when everything was going crazy, and I thought, oh no, there's not going to be any more parks for me to buy. Like I was kind of worried about the pipeline, and then it just went back to supply and demand. It's like, oh man, I'm modeling out, what I think rents will be for storage in 3 years. I have no idea. Like, who knows? They could build a, storage down the street. So, yeah, there's just nothing that. It's one of those things where you find something that works. Why stray? I'm all in. So, and that's what this. I hope it kind of comes around. That's what this presentation is about. Is I'm not selling anything. This is just really spreading the word about mobile home parks as a very investable and good asset class. So I'm just kind of, preaching what I practice.
Sure.
So, yeah,
Do you infill primarily with new homes or also used or mixed?
depends on the market. So, well, depends on the market because there are a lot of markets you cannot do new homes, and you find out the hard way when you're like, oh, okay, they're sitting there dropping the rent, just oh man. But then used homes, it's difficult to find them. So it just depends. I think going in, I have to have a lot of confidence in the new home market, and I think I focus enough in like a tight enough area where, like in North Carolina, for example, I know whether or not we can fill new homes. So yeah, it's just I guess the question is how do you source used homes in a random market? Like in North Carolina, I rely on that couple. Actually, one of our employees, I guess, we bought a park in Tuscaloosa this year, and I don't know how he did it, he found 8 used homes. Actually, you know what it was? There's a park down the street that was closing. It was luck. And so we got 8 used homes there. I never would have, that wasn't part of the underwriting, like, oh, we're gonna find 8 used homes. So it's just, now we're ahead of schedule, it's amazing. But, yeah, that used home, and that's why Andrew Keel's so good. Somebody who can source used, I feel like that's like a cheat code. If there's an operator that can source used homes, that's a cheat code because it's so, you can sell, I don't care where you are, you can sell used homes anywhere. It doesn't matter the market, new homes, not so much. So, yeah.
Chris, you're very understated, gentleman and kind of humble, but can you tell us about some of your, successful transactions and?
I thought I mentioned some already.
I mean, you, like, you know, for us, I mean, I feel like even for us in our first couple of years, you have showed us offerings that look pretty good,
Yeah.
and then you overperformed. Both on the,
Yeah.
you know, NOI increase and the refinance, you
Yeah.
know, cash back and.
Yeah.
Just, if you can just tell that story, I don't know.
Sure. About that one.
Yeah, Bethpage or.
Sure. Yeah. Bethpage is easy. So Bethpage, that is in Kannapolis, North Carolina, which is a suburb of Charlotte. So great market. That was a perfect example of looking at the lot rents and looking at all the other housing options. I mean, Kannapolis' growth has been wild. And just knowing the demand there, that, oh, okay, we have a lot of room to run and nobody will have any issue. I don't even know if we've had turnover at that park after the first year. We got a few bad apples, but after that, I mean, the rents have increased, people continue to pay, people stay. That was one where it was that, and then goes back to what I said about the setup of the park. It's all tenant-owned homes, direct bill city utilities. We don't have to bill any water, we don't have to worry about anything. Expense ratio is super low. It just cash flows every month, and we were able to refinance, take our cash out, and still cash flows paying monthly profits. It's yeah, that's a great one. That's a good example.
What are the attributes of a good market?
I think growth. If you see they're building new stuff, especially apartments, like that to me, like that's it. Now with that said, that's the obvious. Then there's kind of the hidden. You really have to know. I'm just thinking of like one of my earlier markets, which I was saying kind of cut my teeth on, more rural. Demand, oh man, there's such good demand, because there were a lot of not factory jobs. There was a poultry plant in places like that. And they just kept going through people, and it just expanding, and it just big demand that you just couldn't see on paper. So that's more difficult. But the way I look at good market, or just like the simplest way, is growth. So. Are people going to want to live here and be willing to pay higher rents because everything's going up? I mean, at the end of the day, you know, I said before, it's similar to apartments. And eventually, over time, it has to track apartments because it's a housing option. So, if apartments are going up 10% a year and you're going up 2% over time, it's good.
There's a guy in the mobile home park space. He goes by name Frank. So you know, if you know. And he uses the term about lot rents as mom and pop quantitative easing. How they've kept rents so low forever. And he calls it mom and pop quantitative easing. Yeah, Chris is and Rusty are trying to break that.
and again, it's difficult, I think, because again the perception, and that's why I think on the flip side, if the people like Elizabeth Warren understand that if you don't at least have some kind of market mechanism and have them increase over time. Exactly. It's really that simple. And that's why it truly is more art than science. Like I've bought parks, I haven't raised rents for a year. I've done it where I've had to do like 100% in the first 30 days. It all depends. And you have to have justification for it, and it does play into comparable lot rents in the area for other parks, apartment rents, things like that. I mean, there are people who definitely take advantage. I don't think I'm one of them. They say, doesn't matter, we're tripling, it doesn't matter, doubling, whatever. They don't look at any numbers. It's just kind of like it is what it is, and. Actually, they've had some problems. I mean, people, you know, just leave their homes, and it's too high for somebody else to come in. So there are some mechanisms market mechanisms in place that kind of make sure things don't get too crazy, so.
What's that magic number, in your opinion, of lot rent compared to, local apartments?
I do think it's 65%.
65?
I do. It's funny, I bought and sold a park in Wyoming, only owned it like a year and a half. I felt like I ran up against that. And it's funny because
What do you mean you ran up against it?
the 65%, because people were commenting, they're like, seems expensive, we were trying to fill homes. It's like, okay, because I was at 525 or 550, and a comp that I was using, another kind of professional operator, was at 575. I was like, oh, easy, okay, we could be 575. But there were plenty other parks in the area that were in the fours, and we were just getting comments back. It's like, it's too expensive. It's like, okay. I'm gonna sell now because there isn't much rent growth for the future, so.
In your portfolio, are you planning to stay focused on Carolinas? Just broadening it a little bit?
I'm just going where the opportunities are. It's just, I can be, I guess, aggressive in pricing because I'm confident in the markets. Like there's one, 30 minutes from the portfolio we just bought.
Yep.
And,
Near Raleigh, south of Raleigh.
yeah, exactly. It'd be more east. And I'm trying to be as aggressive as possible because we have the experience right now selling homes. We know how much we can sell them for, where rents can be, things like that. So, but yeah, I mean, I've looked at stuff in Indiana, Maryland, I mean, kind of all over. But I think the underwriting, you're just a little more hesitant if you haven't been. At least I am. If you haven't been in the market, so. Gary, Indiana, I thought that'd be a good place to invest, but no, apparently not, so.
Well, tomorrow you're going to Chicago for
Yeah.
Mobile Home Park Conference.
I'm gonna drive through.
And you talked about, he's asking about Gary. Well,
Yeah, but it's just location-wise, it just should be so much better,
yeah,
no?
on the lake there, we're in the lake.
Yeah,
It should be.
yeah, I guess that's.
So, what do you think you'll have some acquisitions in 2027, 2026?
Oh, yeah. You can never project. I mean, what was it, so 2025, so last year, I only did one deal, and that was only because the person I knew and he passed away, so that doesn't even count. So I basically did no deals last year, and then I've purchased 8 parks this year.
You mean 24?
Yeah, 24, 0, 1,
Okay.
and then this year 8, with another under contract, so.
And that's just because of, like, the deals that were brought to you, like, so there were no deals being brought in?
So I think, so what's it's part of luck. I think what's going on now is financing has come back, the options. I mean, yeah, rates have come down, sure, but it's really the financing options. Because a lot of times, I'm trying to think how to simply say it, like you're constrained by certain metrics that the banks look at for a loan. But now there are other options where you don't have those constraints. So you can kind of pay higher prices, numbers still pencil. And so now the sellers are seeing, or the owners are seeing these higher numbers, like, oh, okay, I'll sell. So you're seeing a lot more of that now.
Is it both ways? Are sellers a little bit acquiescing? Or not yet? Not really? No.
No, so so basically what's happened is the financing has allowed buyers to now pay the prices that they were hearing before.
Cost of debt, the terms.
Yeah, really the terms,
Terms,
the
yeah.
structure, yeah. So,
Well, you wanna tell us about your big portfolio you just bought, and was that your biggest capital raise? And
yeah, that's a good call. Yeah, so we bought 5 parks outside of Raleigh. When did we close on that? July? Time's just flown. So that was one where the value add play was the conversion of park-owned homes to tenant-owned homes, and get to our land lease model. We took on 107 park-owned homes, and so the business model essentially is convertible. Sell them, get them on, you can get them on really rent-to-own contracts, so people can pay over time.
So you're the financer for that?
Yes, yep, yes. And so just kind of get it off, off your books, but basically not worry about the repairs. That's the key, right? So get that repairs and maintenance line item down over time. And so eventually the whole portfolio converts to tenant-owned homes. You're in a good spot from a business model, and then you implement your rent increases over time, and then you can refinance.
Why would
So-
anybody have park-owned homes?
That's a great question. So, you know who it works for? It works for the mom and pops that are local, that have the teams, that are willing to themselves go in the homes, know what needs to be done, and do a lot of it too. So basically, they're just subsidizing it with their time. It's really what it is. And that's the only time I've seen, I mean, I guess you'd say success, profitability with the park-owned homes. Because otherwise, like if you're not there doing it yourself, it just eats away. I mean, we've had to replace HVAC units, $7 grand. It's like a whole year's worth of, home rent profit. So, yeah,
Are there any conditions in which you consider building a new?
If I ran out of parks to buy, yeah, geez, that'd be tough. Because here's the thing, that's a much different business model. I mean, we do sell homes, but you're a home salesman. If you're building a park, it's just a different business model. It's kind of like people, oh, you do RVs, like, that's a different business model. Similar, but no, it's really different.
It seems like there's some around the area, we've looked at some, and a lot of them have a bunch of park-owned homes
Yeah.
for sale right now, and they got dirt roads, and all the houses in there from the 70s,
Yep.
and they're still wanting 2.5 million for them. The
That's a
location is good,
Yeah.
but then we've got up north, like Houghton Lake has a good opportunity right now.
Yeah.
That's more of a resort area,
Okay.
but the value, they're just not getting, they're empty, right? So is it you put a house on there, somebody will buy it, or haven't the landlords tried that? They're not infilling, they just been empty forever. There was one in Adrian,
Yeah.
by my hotel that was empty forever, and they had to come in and basically plow everything down and redo the whole thing.
Really?
So I don't know, around here, that model seems to be, there's a lot of park-owned homes, and they're all run down, dilapidated.
That's interesting. So not knowing the market,
Well,
so
around here, we have constant or negative population. And it's a whole different ballgame than if you're in the Carolinas.
Yeah,
you got
nobody's moving to
5% increase
Jackson.
a year. It's just a whole different ballgame.
well, it's interesting. So what I've seen, there are markets or towns that are park-owned home, and what I've seen, it's more military. So like in North Carolina, Fayetteville, in Jacksonville, or heavy military presence, those are very heavy park-owned homes. And it's very difficult to convert, because for whatever reason, it's a park-owned home market. So maybe that falls into a park-owned home market. I mean, that's the other thing too. It can be tough to convince somebody in dirt roads, and it's just like, trailer park, right? We're trying not to have trailer parks. It's tough to kind of sell that, and so it requires a lot of upfront paving, landscaping, all that. But if you're already paying $2.5 million, it's like you gotta put just as much into it. So the price needs to reflect it. It's just the seller's not recognizing really what it's worth. So that's all.
Any other questions, guys, or are we going
Is
to?
there an age that you're looking at from infrastructure wise, like no older than 1970 or whatever it may be?
No, you can't be that picky. I think it's just making sure you inspect it and know what you're getting. So for example, with the Alexandria Park, the pipes were Orangeburg. I don't know if I'm familiar with Orangeburg.
Supply cardboard.
Exactly. So I knew I had to replace it.
Yeah.
And
yeah,
so-
pipers, all that.
So that just goes into the budget. And then, like septics, if they're older than 30 years, you got a budget replacing, one or two a year, depending on how many you have.
So you have parks on septic systems?
I do, yeah, North Carolina is very
No
popular with
lagoon?
septic. No lagoon, each individual home has a septic.
Okay.
Yeah, that's very, very common in North Carolina.
And you pay for that every year to have those pumped, or do they pay to have them pumped?
We pay, yeah. A lot of times, if we don't do a schedule, it's just as needed. So, I think it's supposed to be every 4 years, so, yeah.
And acquisition, what's your primary form of financing? Is it primarily bank or Freddie, or depends on the size?
Does depend on the size. I say recently bank. So Presidential Bank has been really good. They love parks, and we formed a relationship where I kind of use them as like a bridge lender, right? So they know that the park isn't, it's probably not ready for, the ultimate goal is Fannie Mae, Freddie Mac, right? That's the cheapest. It's government subsidized, essentially. That's the cheapest form of financing. And so either can't get it out of the gate because they have certain criteria, or it's better off to wait, kind of, infill, rents, all that stuff. And so we've been using Presidential as like a bridge lender. So I'm gonna refi them out for two parks come beginning of the year, and go into Fannie Mae debt, right, so.
Do you know if Live Oak is in this space?
I don't, no, they're not, I don't think so.
Okay.
Cause I think did you touch on them before? Live Oak out of North Carolina?
Yeah,
Yeah, yeah. Yeah, no, I have not seen them. I think I opened some like checking accounts, but I don't think, I haven't used them for any loans.
Okay.
What's the event in Chicago you're going to?
Oh, it's actually not that exciting. It's just like one of these NCC. It's there's each year there's a major one in Las
Home park
Vegas.
industry event.
Yes, yeah, sorry, it's a MHP industry event. The big one's in Las Vegas. I don't even know if this one's regional. I went last year. It's just a good opportunity to network. I have some meetings.
Network with who,
scheduled.
brokers?
Yeah, brokers. So I'm meeting with my lender, potential investor group, my title person, and a broker. So it's just setting up meetings. It's kind of, that's really all it is. I think there's some informational things, but I didn't get any good information last year. There are other conferences for that. This one isn't really like that, so.
Do you do your own due diligence internally?
I do, yes, yeah. The big thing for due diligence is the third-party reports, like on-site stuff, go do that. It's like zoning, because that's a big part of it. You gotta see if there are any rules against infilling and things like that. Environmental report, make sure it's not a former, dumping ground or something like that, and survey. So those are the main, we get those right away,
Okay.
then we'll go on site, do our diligence.
Do you do any kind of market study, or is that just your own stuff that you do?
Yeah, yes, in terms of like hiring, or
Yeah,
we
like
just do it
third-party.
ourselves, so like, just bestplaces.net, so you can get a sense of like demographics information. I think that just pulls from census. Actually, a lot of good government websites. One that I like is looking at HUD's fair market rents. That's a good indication. I think that's what they pay for Section 8. And then Zillow, stuff like that. It's really getting an understanding, well, one, population growth or whatever decline, and then rents and home prices. It's like, those are the main things. And then once you're on site, again, just driving around, seeing what's being built. Like one of the kind of the draws of the Raleigh portfolio is just driving around that area. The number of single-family home developments, new ones, it was wild. Hundreds and hundreds of new single-family homes. Because it's all just, the seller was telling me, because the county that it's in is cheaper tax-wise than the one right above it, which is closer to Raleigh. And so you just got all these people coming down. So something like that, just driving around, I mean, it's, you know, new shopping centers, things like that. It's, because at the end of the day, you know, real estate, location, it really, I mean, parks aren't much different for a lot of the cliched real estate kind of investment theses. So.
One of the, what do you call it, not rules of thumb, but like quick and dirty things, I use the Walmart rule.
Yeah, that's a
I
good one.
like that.
Yeah,
You know?
that's a good one.
You wanna describe that?
So it's basically if you have a Walmart within 5-10 miles, because the amount of research they do and money they've put into site location, I mean, it's pretty good. And, you know, it's jobs for your tenants. It's, you know, it's just a good
I
indication.
tried to get Rusty to buy one that the road to the parking lot to the Walmart was the border of the park.
Oh, man.
And he chickened out on it.
Oh man, I've seen that in North
I'm
Carolina.
like, have you ever heard of the Walmart rule?
Oh man,
Couldn't get any closer.
that's good. Really? Oh man. Oh, yeah, that's should be kicking yourself.
Yeah.
I'm sure that was a good one.
That and many others.
Yeah.
Rusty is a Michigan-based Walmart owner-operator. He's also doing a great job with us and very appreciative of his.
He's got a good education too.
It's true.
Michigan State.
GMI or Kettering University, it's a small engineering school.
Got
that
it.
we happen to have both went to.
Oh, got it.
Well, thanks a lot, man.
Yeah, thank you guys. I
Appreciate
appreciate it.